the party this evening. Gigi, would you like to give any personal and biased invitations?
Gigi, Mark, I saw you just put your headphones in. Do you want to plug the pie tea?
Of course, in one moment, my earphones are in. Can y'all hear me okay? Okay, fantastic. Yes, so today is the Platt Pie Tea. So 4 to 7 at the Heron Park. A lot of you guys RSVP'd, so very excited to see you. We'll have Keurigs for hot drinks and little snacks, and Buddy the Alpha Santa Claus will be there. So it'll be a great time. And also you can pick up your Winterlight tickets there as well. So that's part of it too. So I'll see you guys this evening.
Apologize in advance that everyone will have to remain socially distant from Buddy the Elf and Santa Claus. Maybe next year we could have like a photo booth or something like that. It's just going to be distance photos.
This will be baby Logan's first exposure to Santa Claus.
I am really sorry about that. He's going to get, I feel like the Santa Claus I'm picturing is like the one at the Castleton Mall, which feels very much like North Pole-ish or Sullivan's Hardware. This is going to be like the poor man's Santa Claus. So maybe we're just setting the bar low, and next year he's going to be really excited about what he sees.
You know, she'll never remember it, so.
Yeah, sorry, she, right. Oh, gosh. We'll look forward to seeing everybody in person. Quick side note, I feel like this is big Indianapolis news that broke in the last 24 hours. Did y'all see that Ambrose has settled its lawsuit with the city of Indianapolis, not dropped it, settled its lawsuit and sold the GM stamping plant site? It will be the future world headquarters of Elanco. That's formerly a division of Eli Lilly in the basically animal, like veterinary pharmaceutical space. Lilly spun it off a couple of years ago, so it's its own company now. But yes, Billy, no doubt in terms of broad city impact, the waterside development would have been radically different. Maybe not the ideal, but $100 million global headquarters of a growing company isn't all that bad either.
Yeah, my Edge mentor, you know what Edge mentoring is.
Yeah.
He's at Elanco. He's been there for a long, long time, has had numerous high positions. So he's been keeping mum on that, but he did mention a very large deal in the works. So this is what it was. So we've been all texting him about it this morning.
Okay. Well, good to see everybody this morning. Thanks for those of you that have turned your cameras on. Always appreciate that. I am going to dive in with a discussion question that I would love for at least one, maybe two of you to answer. We chatted earlier this week about the word wealth and some of those feelings that come up when we use the word wealth, particularly kind of a negative connotation. And a lot of you shared openly about that. I appreciate that. Would anybody be willing to share in the last 48 hours, did you find or create the margin to kind of process a little bit what your internal reactions about the word are, and have anything that you feel like, yeah, here's what that was like for me? So maybe kind of a slower processing than in the middle of a Zoom call, but anything that came up that you found helpful or challenging about processing your own internal reactions to using the word wealth? Just a light conversation starter to kick us off.
I would say just as simple as the liability versus asset, and just starting to put things in those categories was is helpful for me.
Mm-hmm.
I think like the book especially helped me identify just a perspective of fear with wealth, that it's something you have to get and hold on to like tightly, that it's something that will go away rather than something that you should utilize and control.
Mm. Those are both really good. Sarah commented on the chat that she found herself thinking about where all of my attitudes and feelings towards wealth came from. And yeah, maybe like investigating a willingness to just reevaluate, not necessarily change your mind, but to ask the questions again. Yeah, be more curious than judgmental. That's a good way to say that. Not necessarily starting that thinking about here's where I want to land on my opinion of wealth as a word or a concept, but just kind of being willing to say, let me try to realize where my thoughts and feelings come from, to identify that, and then ask the question again, seeing where you land. I think that's a good spot to be in. Okay, we're going to be a little bit less philosophical today than we were a couple days ago. We'll probably also be less philosophical in the third session, and then we might kind of pivot back a little bit more towards some philosophy about money and wealth in session number 4. But if y'all know me, I probably can't stay away from philosophy for too long, so we'll probably hit on it a little bit today. So I'm going to pull up our outline here. Rosie, oh, never mind. I've already got permission. Thanks for that. Just as a quick reminder. So we're going to circle back to why I have this text here in red. But 2 days ago, we talked about the problem that financial literacy is lacking, particularly for small business owners. So how did we get there? We talked about the alternate perspectives, thinking about money in terms of 30-day periods of time, which is AKA budgeting or cash flow, versus thinking about money in terms of wealth or a lifetime perspective. We're going to be looking at that from different angles in all 4 of our sessions. We talked about Rich Dad, Poor Dad, referenced a couple of the alternative reading suggestions, and then talked a little bit about why is this particularly relevant for realtors, because we're a group of people that are small business owners that act like we have a job. Today, we're going to do Business 101. So we're going to go over the profit loss, the balance sheet, the difference between the two, and then what does a balance sheet for you as an individual look like? That's the agenda for today. We sent out the sample profit loss and balance sheets, and just a quick article from Investopedia. Some of you may have looked at that. So this might be repeat, but I'm just going to kind of go through the profit loss and the balance sheet using the samples that we sent out to explain the concepts. And I'm going to stop after each one to answer questions. And I would encourage you, if something that I say or something that you're looking at doesn't make sense, I can 100% guarantee you someone else on the call is thinking the same thing. Drop it into the chat, unmute yourself, and ask. I'll provide spaces to do that. So I do want this to be Q&A. I know it's a little bit weird in Zoom to do that, but I think that's how you're going to get the most out of this. So the goal being, at the end, if you can articulate what a profit loss is, what a balance sheet is, what the difference is between the two, and why that difference matters. So if you can say those 4 things, then I think we had a successful 90 minutes. Cool? Okay. I'm actually going to share my screen again. Okay. So here is a sample profit loss statement. And just FYI, you could look at 100 different profit loss statements of 100 different businesses, and they're all going to look fairly different because in different industries are going to structure the like outline of their profit loss in different ways. But the thing that they're all going to have in common, a profit loss is always going to have revenue at the top, expenses at the bottom, and then a sum of those two under the expenses. And the sum is either going to be positive or negative, which means if it's positive, the company made money over that period of time. If it's negative, the company lost money over that period of time. And as an individual, if you want to think about a profit loss as it like compared to how you manage money as a person or a family, this is like your budget. It's like your budget in hindsight. Okay. So profit loss focuses on a period of time. Most of the time, they're broken down by months. So companies will typically do a finalized profit loss at the end of every month. When you hear people talking about in accounting terms, when you say you're closing out a month, usually what that means is, so like right now, first week of December, accountants in businesses all over the country are working on closing out November. So they're making sure that in their November profit loss, they have accounted for any revenue the company had in November and any expenses the company had in November. And once they think they've finalized entering all of those things, they say, I've closed out the November profit loss. I've shown all our revenue and expenses, and we see the sum of what the company made or lost during that period of time. And so that's when we say it's the focus on a period of time. A profit loss has to have a starting point and an ending point. This is one of the differences between this and a balance sheet, okay? So this sample profit loss that we're looking at for a generic company, I don't think this is a real company, was for the 5 months ended May 31st. So what that means is this is from 2017. This is the performance of a company for the first 5 months of a calendar year. Okay. So at the top, you normally have a line like sales or gross revenue, something like that. So this company sells some sort of product that they had $100,000 in revenue. Okay. So let's assume they're selling little, I am so sorry to use this word, but I can't use any word but widgets. If any of you went to business school, you probably got sick of hearing the word widgets because it's what every business class in the whole country was probably using when I was in college. Maybe they found a different word, but so they're making widgets that they sell for $1,000 a piece. Okay. And over the first 5 months of the year, they sold 100 widgets for $1,000. Therefore, their top line revenue was $100,000. The cost of goods sold means that it cost them $750 to buy or build each of those widgets. Okay, so the $100,000, you could think about it as if they had 100 customers come in over that first 5 months with $1,000 in cash each. That's the amount of money that came into the company. And then the amount of money that was attributed to each of those items was $750 in production cost or purchase costs. Therefore, their gross profit is $25,000. There's a lot of confusion in talking about different industries sometimes in terms of the word sales. So you'll hear companies say like, oh, we did $1 million in sales last year. Well, you really have to clarify. Sometimes people mean gross profit when they say that, and sometimes they mean sales revenue. So like, I'll just use an example. You guys know I've been in the car business for a little bit personally, but my family's been around the car business. It's something that people can kind of get their arms around easily. A car business might sell an asset for $20,000 pretty often, right? Plenty of $20,000 cars out there. When a car business sells a car for $20,000, 20 grand is going to go into this top line sales number. But that's not really $20,000 in revenue, right? Not gross revenue for the company, because the asset that they sold had a significant cost to it. It might have had an $18,000 cost. And so the number that really matters there is the gross profit number. But this is typically a nice way to account for it so that you could see what your normal margin is. Now, don't worry too much about, like, wait a minute, this is a lot different than realtors. We're going to circle back to this, but you're probably thinking, wait a minute, when you're in the brokerage industry, you're not selling something that you own. Like, we're not building something or buying something that we have money invested in to sell, right? Revenue for us is a payment for service. So don't worry about that for now. I'm just acknowledging this would be a more normal profit loss. Most businesses would have something like this. In a service industry, your sales revenue and gross profit are likely the same. Okay. After you determine gross profit, then you're typically going to see an operating expense category, or sometimes they're called marginal expenses. So these are expenses that are directly related to the main operation of the business. And they're oftentimes going to be correlated to the size of your sales operation. Okay. So there are some things in a business that as you start selling more and you grow, certain expenses are going to increase with that sales growth. Those would typically be in this operating or marginal expense category. So here you see advertising, commissions expense. This is a business that is apparently paying a sales staff commission, office supplies expense, office equipment expense. A lot of times you would see like payroll. So if the business has employees, this business looks like it has maybe like independent contractors that they're paying commission only. So things like HR, marketing, office stuff, all that's going to go here in operating expenses, because it will go up and down with the size of the company. The more it's selling, the more you would expect to see here in these categories. So you've got $7,000 in the selling expense category, $6,000 in the administrative expense category, $13,000 total. Operating income is calculated by saying, okay, what revenue did we get from our sales process minus what were the expenses that were directly connected to or attributable to the main operation and sales process. Okay, so that's your operating expense, or sorry, operating income. It's $12,000. Then you'll have a secondary expense category, non-operating, fixed. Sometimes would be a word that we would use. So like it's operating expenses versus non-operating expenses, or marginal expenses versus fixed expenses. These are things that are not necessarily directly tied to the sales operation, but are likely going to be costs that you incur regardless of how much you're selling. So this company has, they appear to have some debt that they're paying $5,000 over a 5-month period of time to cover that debt in interest. You see loss from lawsuit. I'd love to know why a simple company like this had a $1,500 loss in a lawsuit at some point in 2017. Hopefully that's not going to end up on your profit loss, but just a couple examples of things that aren't directly tied to the main operation of the business. In this particular case, they are calling their non-operating category here. This is going to be a little bit confusing. They're actually categorizing their non-operating as revenue. So that's why you see a $12,000 operating income. Non-operating or other ends up positive, which means their net income is $18,000. Different companies will label the non-operating category differently. And sometimes the non-operating number will be positive and sometimes it will be negative. So really what you're trying to do is say, what's a part of our critical day-to-day business operations that goes in the operating section? And then what is secondary or tertiary, so financial transactions that the company is doing that aren't a part of our primary business? And are they positive or negative? So you don't need to think a ton about that. This is just to help you familiarize when you're looking at a profit loss, just to kind of help you get your arms around what you're seeing. So what this profit loss shows is that in a 5-month period of time, the company made $12,000 from their primary business objective, and they made an additional $6,000 from non-primary business objectives for a total over a 5-month period of time of an $18,000 profit. I'm gonna unshare here for a moment. Actually, I'm gonna keep this up in case somebody wants to ask a question so that I can see this. But I wanna be able to see the chat. Forgive me for a moment. Okay, forget it. Now I can see the chat. As you guys look through the profit loss, what questions do you have? What stands out to you? And feel free, if you're like, I just don't understand any of this, I would at least like that feedback. I don't know that I can answer that question, but what questions do you have as you look through this profit loss or just in general about the concept of a profit loss? And if you're confused, I can promise you someone else is.
Hey, I can't type that fast on chats. Can I just jump in and
Please.
okay, so looking at this, we've had such a strange year. And so for those of us who like took PPP or an SBA loan, I feel like that's something that would probably go in the non-operating expense category. Like that's the section that I look at and I'm like, what in my business actually applies there? The operating expenses seem really straightforward. The non-operating expenses and the fact also that they're showing like they have an interest revenue that they're showing as a positive number, but you're saying it's a debt. I'm not sure how to read it. What, like for me, that non-operating end is the most, I guess the most elusive, but also I feel like this year is maybe the first year that I have I have reasonable things to put in there because I feel like the PPP situation probably ends up there. Yeah, let me know.
That's a really good question. It's actually a really great example of how understanding the profit loss and the balance sheet in connection to each other matter. So what I'm about to say might be kind of confusing. I might have to say this a couple different ways. Your PPP loan initially would show up on your balance sheet, not on a profit loss, because it's debt. So you borrowed, let's say you got a PPP loan for $10,000. On your balance sheet, you would show the $10,000 in cash that you got in the loan as an asset. It shows up in your checking account, which would be on your balance sheet. And then on the other side of your balance sheet, you would show that you owe the SBA $10,000. So it's an asset and it's a liability. What's interesting about the PPP loans is that it appears the majority, or maybe even close to all of those, are going to be forgiven. And what happens to a loan when it is forgiven? Well, the liability disappears. You actually now don't owe the SBA the $10,000. When the liability disappears, sorry for the accounting lingo here, you have to make what's called an adjusting entry. Now, all of a sudden, that $10,000 in cash that showed up as an asset, it needs to be declared as income. So there's actually still some debate, but it looks like the federal government is going to say, if you took a PPP loan and it is forgiven, you're going to have to declare that $10,000 as income and therefore probably pay taxes on it. Depending on what tax bracket you fall in is going to determine how much you end up paying. So that 10 grand will move from your balance sheet and drop onto your profit loss at the moment that it's forgiven. And yes, Trisha, it would very likely show up in your non-operating. That's where you would probably choose to put it. By the way, Trisha, your question made me realize I misspoke. I said the wrong number earlier. I'm going to share my screen again here really quick. I think I caused some confusion by looking at the wrong number. So looking at that profit loss again, I said 5,000 and I meant 500. So their interest expense on debt that they carry is that interest expense 500. That's money that they had to pay on a loan that they had. This is money that they're earning for a loan that they have out. Perhaps a customer financed something that they bought from the company and is now paying interest to the company for that. So sorry for the confusion there. What other questions do we have about a profit loss? If we were in person, I could try to get a vote on this by hands in the air. I guess I could do that via Zoom too. I want to make sure everybody understands what I mean by a profit loss covering a period of time. So if you're looking at revenue and expenses, you have to bracket from what day to what day. You can't create a profit loss without having a starting point and an ending point because it talks about a period of time, usually 30 days. Just like we talked about, our main way of thinking about money is in 30-day on our personal budget. We think about how much did I bring in this 30 days? How much did I have go out in 30 days? Right? So a profit loss is kind of similar to how we think about budgeting. Has to have a bracket of time. Okay, two good questions there. What is the commission expense line? So that like this company appears to not have employees. Probably a really small business, so they don't have like a payroll expense line. That commission expense line with this company is paying a commission probably to an independent contractor who is selling that product. Any other example of non-operating expenses for a real estate agent or business? Phil, that's a good question. So you could, as a real estate professional, let's focus here. Let's assume for a second we're talking about an individual agent who is their own business. You might be paying an accountant $500 a year to review your books every quarter and do your taxes. Well, you're probably paying more than $500 a year. That would be a non-operating expense. So if you are paying Google or Zillow to do some advertising, that's an operating expense. If you have a relationship with an attorney or a CPA as a professional, that would be a non-operating expense. It's not directly tied to the kind of main primary nature of your business. It doesn't mean it's not worthwhile or it's not important. It just means that it doesn't directly connect or vary with the service that you're providing. Realtors also borrow money. So you could have a situation where you would say, you know what? I mean, not many people at Platt do this, but it's fairly common around the country. There's realtors in Indianapolis that are spending 6 figures a year to purchase leads. And many of them are borrowing that money. They will go obtain debt so that they could be spending $10,000 a month to purchase leads. And they just know I can borrow the money because I know what my closing ratio is. And so if you're borrowing money, the $10,000 is an operating. So the $10,000 that you spend every month would be an operating expense. A non-operating expense would be the interest that you were paying on the money you had to borrow. Hope that's helpful, Phil. Probably confused someone else with that answer, but that's okay. Yeah, good question, Trisha, about the cost of goods sold. Yeah, as a realtor, you probably don't. Something that could end up as a cost of goods sold. Raise your hand if you've ever had to buy a water heater for a client. Yeah, Angelica and I were just talking about this. I've actually purchased multiple water heaters, FYI, in my career. I'm not bragging about that. That would be the best example I could come up with. Typically, a cost of goods sold is if you own something that you're selling. You had money invested in the thing that you owned, so you call it a cost of goods sold. In real estate, you don't own a physical, tangible product that you're selling. You're getting paid for a service, so you generally are not going to have a cost of goods sold. You could put in things like that you have to concede into deals occasionally as a cost of goods sold. I think so. The way that I have always done that when I've had to do it is that I actually put that in as a negative income. So if I make $10,000 on a transaction, but I had to buy an $800 water heater, I'm going to put 2 entries in as income. So I'm going to show a $10,000 revenue and then a negative $800 revenue, so that when I look at it on my profit loss, I'm just going to see a $9,200 revenue. But you could put that 800 in as the cost of goods sold. I'm sure many of you have never done anything as foolish in a deal as I have that required you to buy a water heater. So congratulations to those of you that have not yet bought a water heater. When you're 20 years in, call me and tell me if you have ever bought a water heater. Is Angelica the only other person on this call that's bought a water heater? Phil's bought one. Thank you, Phil. I think Jenny's bought a water heater. I'm pretty sure you've had to buy one at one point, Jenny.
Why water heater? Like, I just helped buy a fridge for somebody because
you had to buy a fridge.
I mean, thankfully it was like a garage fridge, so it was a lot cheaper than if it had been something else. But like, what was the deal with the water heaters?
Because it was the first one for me. It was the first thing I had to buy like that in my first year in the business. That's why it sticks out to me. It's not the only thing I've had to buy. Yeah, Jenny, that's right. You had to buy a radon system not that long ago. Congratulations. Hopefully some of you newer agents are like, oh my gosh, I felt really bad about having to do that. And now I'm hearing these people that are kind of experienced that I thought knew what they were doing had to buy an appliance at one point in time. So hopefully that's good news for you. Okay, I'm going to jump to the balance sheet unless somebody else wants to stop me and say, hey, real quick, clarify this for me on a profit loss. So you have 10 seconds. Okay, I'm going to screen share and we're going to take a look at a balance sheet. So a balance sheet, what makes it different than a profit loss, and I'm going to hit this a couple different ways. A balance sheet is a momentary snapshot. It's a picture of a business at a very specific moment in time. It doesn't have a start date and an end date like a profit loss, because it's a visual of what the company owns, OWNS, owns on the asset side, and owes, OWES, owes on the liability side. So, spoiler alert, this is going to tie to what a personal financial statement is for a person. They're the same thing. But a balance sheet shows you a momentary picture of the financial status of a company. Okay, so I'm going to go through this as an example. So normally on a balance sheet, the very first asset that you're going to see is cash. It's money. That's normally the one that's going to show up first. You might see this listed as like a checking account or an escrow account or a credit account or something like that. So you'll have kind of different varieties of showing what cash balance you have. And then a variety of investments or accounts receivable. This is where this can get a little bit confusing, and we're in the nuance of accounting. But when someone owes you money, so for this business, that might be if they're selling things for about $10,000, this accounts receivables net, this $40,500. That might be a deal that they had closed that they haven't been paid for yet. The product was delivered, they just haven't gotten the money from the customer. So they don't have the cash, but it is still an asset when someone owes you money. Inventory, so think about this, if they have $3,000 per piece of inventory, they have 10 of those. Just they have a dollar amount attributed to the value of what they have sitting on the shelf. Okay. Supplies might be things that are not yet put together to make inventory, but yet they are of some value. Prepaid insurance, I'm going to skip that one. Basically, prepaid insurance is something that they have sent off to a vendor. They've made a payment for something that they have not yet received. That's going to really get into the details of accounting methodology. We don't really need to worry about that, but it's essentially they're saying we own $1,500 of insurance that we have not yet used. So you don't need to understand that. And then you're going to see sometimes they subtotal, so like total current assets, or that $89,000 is the sum of what's above it. Investments, that could be perhaps this company might own a share of another company, or perhaps they don't like keeping a bunch of cash on hand, and so they have some sort of a mechanism to take cash out of the business and put it into an investment. Okay, but that's something that they own that they're declaring to be worth $36,000. Property, plant, and equipment. This might be the easiest to understand on a list of assets. These are things that they own that they're declaring a value to. So this is not necessarily what they have invested in those things. It could be, but it's what they have declared they are currently worth. So they own $5,500 in land. They have improved that land by $6,500. Maybe that's like a parking lot sitting on a piece of vacant land. They own a building that they think is worth $180,000. They have $200,000 in equipment. And then they have depreciated that by the total by $56,000. So what that means is they at some point have declared that $56,000 as an expense. They're saying here on paper that those things have become worth less money over time. It's usually a tax strategy. This really gets into the nuance of accounting. I'm not worried if y'all understand the concept of depreciation yet. This just gives you an example as to why understanding a profit loss and a balance sheet for a business owner really matters, because depreciation is usually a really good tax strategy. Okay, so consider that, like put a pin in that. We'll come back to depreciation, but What that means is they have said these things were at some point worth 5,500, 6,500, 180,000, 201, but we think they have decreased in value by 56, which is a tax advantage. Therefore, they are now worth a total of 337. Okay. Intangible assets. I wanted this to be on here because they're generally going to be on balance sheets, but these are things that the company believes they own that aren't there. There's nothing you could like go and hold in your hands. That's what intangible means. Goodwill basically means a customer database, an existing reputation, that there is actual value on a piece of paper declared for the goodwill of that business. Trade names is like essentially their brand. The visibility of a name or a logo actually has value to it. So a lot of times when a business sells, when you think about people selling a business, this is usually where the real value in what they're selling is. So like, I've been a part of a transaction where my family sold a car business 13, 14 years ago. When selling the car business, you're selling the land, you're selling a building, you're selling inventory, all these cars, but determining what those are worth is fairly straightforward. Really, what the buyer and the seller are trying to determine, what's the goodwill and trade name value of that business? Okay, but it is actually an asset. Little fun side note, businesses can have negative goodwill value. Could think of some examples, but I probably won't mention them to avoid just being critical. But there are businesses in our industry that I think at some points in time probably have negative goodwill value, or there are industries where the trend in the industry is really bad, and the business probably needs to have a negative goodwill value associated here. So you take all of these things, money owed to you, physical, tangible assets that you own, and intangible assets that you own, like goodwill. You sum all of that up. So the company has a total asset line of $770,000. Okay. Jump over to the liabilities. Liability is something that you owe. This means the $770,000. That's not the worth of the company. It's only the positive side of the ledger. So your liabilities, in this case, note payable, account payable, wages payable, interest payable, taxes payable, warranty liability, and unearned revenues. These are all methodologies to label things that the company knows they're going to have to send out in the future. They have some form of commitment to pay these things. And this is not like what they owe per month. So if you're thinking in terms of a person, this would be the balance of your mortgage, not your monthly payment, right? So think monthly shows up on profit loss. Total lifetime balance shows up here on liabilities on the balance sheet. So they have in current liabilities, usually current might mean something that they're going to have to pay off in the next like 30 or 60 days. Normal operations of business. The 35.9 is probably this accounts payable. That might be something that they just bought for their inventory that they haven't paid for yet. Notes payable and bonds payable down here in their long-term liabilities, think much longer term debt structure. This is like 10, 15, 20, 30 year amortized debt that is just going to have to be paid off at some point in time, not in the immediate future. Total liabilities for this company is $481,000. Stockholders' equity. You can almost not worry about the word stockholder. The formula here from an accounting philosophy is that assets equal liabilities plus equity. So this is why you see assets on the left side and liabilities and equity on the right side. Because if the company owns $770,000 of stuff and they owe $481,000 worth of stuff at a given point in time, that company's worth, its value, its wealth is this $289,000. You don't need to worry too much about the common stock, retained earnings, comprehensive income, the negative treasury stock. I did keep it, I used this example on purpose because this is how a lot of balance sheets are shown. But I think the concept that you're trying to grasp here is that this business owns $770,000 worth of stuff. It owes $481,000 worth of things. And therefore, it has wealth equal to $289,000. So the total of your liabilities and your equity always has to equal the total of your assets. That's the formula. That's how this spreadsheet works. The 481 plus the 289 equals 770, which has to equal this 770. I know there's some confusion because anytime I think people are new to financial statements, a profit loss tends to make a bit more sense than a balance sheet. I'm going to just put a little plug in here and say, I think that's because we've been conditioned to think about money over 30-day periods of time. So the concept of thinking about money as what came in versus what went out helps us categorize a profit loss. We're not conditioned to think about money as wealth. So therefore, a balance sheet tends to be a little bit newer of a concept. What do I own versus what do I owe? And what is the difference between those two, equaling equity? In a moment, I'm going to let you guys unmute and ask questions, but Johanna has asked a good question there. Is there a standardized way of determining the value of these assets? Yes, industry to industry. So different industries are going to have different best practices in determining what they're using for the numbers on the balance, on the asset side of their balance sheet. Y'all unmute yourself, comment on the chat. Do you grasp the concept of the balance sheet? What's confusing to you? What questions come to mind? Maybe from that sample balance sheet, or like, how does this apply to realtors?
I'm most intrigued by the intangible asset thing because I had just never thought about it. But I can understand how in a business buyout scenario, the intangible assets are more negotiated and that, dollar number is agreed upon mutually because, oh yeah, this name of this brand is good and it's worth this to me. But how do you really determine intangible assets today, right now? And then two, what's the point of quantifying that? Is that something I tell my accountant, I've got $100,000 of goodwill out there that you need to keep logged away. Am I supposed to be doing something with that? Or I'm just kind of confused about it.
Can I tell you guys how happy I am that Phil Kirk asked this question? Because it's really gonna help me embrace the answer to this, because I'm gonna get to tease Phil about what he as a human being is worth in terms of dollars. Because Phil, your goodwill value is higher than the average. We all love Phil, and Phil has a lot of goodwill value. No, as a realtor, there is not going to be much tangible, sorry, I'm not going to use the word tangible. There's not going to be much real-time value to you worrying about your goodwill value as a realtor. Now, if the point in time came that you're ever going to try to sell something, sell your business, sell a team or your book of business somehow, that's really what you're doing. But I think the concept matters to a realtor, because in a service business, when you're creating wealth as a realtor, a lot of what you're creating is an intangible asset. It's the combination of all of your education, all of your experiences, all of your relationships, your personality, all of those things go into a valuable asset that allows you to generate income in the future. But as a realtor, there would be very few point in times where you would need to or want to declare an actual dollar amount to that. Where this is going to be more applicable is in, like, say, a company that's about to sell. So Phil, you talked about, well, okay, I get it, why in a transaction you'd have to declare that. But think about like a publicly traded company. A publicly traded company has to constantly declare what they believe the company is worth, because it has a stock price that's going up and down. And a company's stock price can go up and down regardless of any sort of physical asset that it owns. So just as a, not super applicable to realtors, but in terms of why some businesses might have a fluctuating goodwill asset. I think if you were a small business that really had to use debt a lot to grow your business with a banker, you might want to try to make the case for goodwill value. As a realtor, I would not recommend that. If a realtor was using a goodwill value asset to try to borrow money from a banker, number one, the banker's probably going to laugh at you. Number two, it probably means you're about to over leverage. But a really large medical device sales company, they probably at any one point in time might need to own millions of dollars in medical devices. And they may try to go borrow money to be able to buy those medical devices that they then sell. And if they can demonstrate this track record of great relationships and lots of sales, the bank might actually attribute some value to them on goodwill. So that might be an example where a banker would look at a goodwill value and say, yeah, okay, I'll concede you that that's worth $100,000. As an individual service provider, I would say you're probably never going to try to make that case. Yeah, Kristen, Billy's referencing the goodwill value of Chick-fil-A. We could talk about, I think in different circles, it's really positive or really negative. Chick-fil-A would be an interesting case study on its goodwill value. We're not going to talk about that in this call. Kristen asked for recommendations on a website that you use for creating P&L and or balance sheets. Yes, we will likely circle back to this. I have used QuickBooks Online as a cloud-based software for a decade, and it's really simple. I think it's pretty user-friendly. I like using it. You can also, I'm going to share a very simple spreadsheet. Your balance sheet as an individual is what's called your personal financial statement. We're going to come back to that. I like QuickBooks to create financials, and I think the account is worth it, particularly the more that you're viewing yourself as a business owner. Trisha is referencing Wave. I haven't used Wave, but yeah, there would be the kind of standard QuickBooks Online, I think, is like $30 a month. There would be free versions of something very similar. Cameron asks, is it solely up to the business to determine their goodwill value? In other words, can they just say their goodwill value is X so that their assets is a certain amount? Yes, you can. But then it's going to be all about, what are you using that balance sheet for? Who is it that you're going to need to make a case about something by using that balance sheet? Is it a banker? Because then the banker is going to look at the balance sheet and say, Cameron, how'd you come up with 100 grand goodwill value? Where are you coming from on that? What norm did you use? Or if it's a buyer of your company, they're going to say the same thing. So yes, you could use any sort of defense that you wanted. But then it just, like, the next question is, what are you using the balance sheet for? And somebody's just going to question your methodology. So in theory, yes. In practice, no.
Sorry, I have one quick question to piggyback off of intangible. Have you ever used intangible assets when pitching like private money investing? Or am I misusing the definition of that word? Because I feel like if I sit down with someone to raise money, I'm talking about our intangible assets. I'm not really quantifying it, but I'm saying, like, here's the good we're doing with it, blah, blah, blah. Have you ever had that come into play with a pitch like that?
I think there's a connection between the two, but I think in our industry, you're not using the actual accounting methodology of intangible assets. An investor in most industries is going to prefer that you use tangible assets and liabilities to determine equity. So because it's the more conservative, you follow me on that? Like, if you're trying to show on a financial statement what something is worth, be it your business or you as an individual, the more conservative methodology is going to be preferred by the person looking at it, be it an investor or a banker, because then they have more confidence in that number being real. Yes, Jenny, a patent or some sort of copyright would oftentimes be an intangible asset that could be worth a lot of money. Relevant example, because we just talked about Elanco, Eli Lilly. I've never seen Eli Lilly's balance sheet. It's probably accessible somewhere. Eli Lilly is probably worth a ton of money. Fair? Well, on their balance sheet, it's going to show, like, well, we own this huge piece of land on East Street, and we have a bunch of money in the bank. But Eli Lilly's primary value is going to be intangible assets. It's going to be goodwill, it's going to be brand name, and patents. So when Eli Lilly patents a new drug, they just created a ton of value that they're going to be able to capitalize on in the future, but it is actually an asset today. Okay, can I transition? Sharing my screen again. Okay, I'm going back to our outline. I'm going to be redundant here, and I'm going to read what you can look at here. This is a little excerpt from the Investopedia link that Rosie sent out, talking about the profit loss and the balance sheet and the difference between the two. Although the balance sheet and the profit loss statement contain some of the same financial information, including revenues, expenses, and profits, there are important differences between them. Here's the main one. The balance sheet reports the assets, liabilities, and shareholder equity at a specific point in time, while a P&L statement summarizes a company's revenue, costs, and expenses during a specific period of time. So to think of it another way, the balance sheet is a snapshot of a position, and the profit loss is an understanding of movement. So balance sheet, a position at one period of time, profit loss movement to the positive or negative over a, sorry, I misspoke there. Balance sheet snapshot of position at a point in time, profit loss and understanding of movement, positive or negative over a certain period of time. If there is one thing that I would instill to you as business owners, if you can correctly articulate that difference, then I think you're on your way. And I want you to think about for a moment as an individual business owner. So whether this, honestly, guys, like whether you own an LLC or you're a sole proprietor or you own an S Corp, that's not really what I'm talking about. It's a good question, something to think on. You are a business owner. A realtor is a business owner. If you don't own anything, you're a sole proprietor, okay? What would some examples be of a profit loss in our industry? So a lot of realtors don't actually use QuickBooks or Wave to maintain a profit loss. That's fine. If they do, then they know what their profit loss is. But what are some things that force us to calculate our profit or loss in a year? There's one really big one. When does a realtor typically calculate their annual profit loss? Yeah. Phil and Sarah both nailed it. Phil won. Congratulations, Phil. I'm sorry, Sarah, second place. It's taxes. I am actually convinced that most realtors, if for whatever reason, if our economy was built by taxing spending rather than income, most realtors couldn't tell you how much money they made. They would have no idea. They would not be calculating their profit and loss unless you had to pay taxes. Yes, Kelly, good. Kelly, this is fantastic. Thank you. I didn't plant this. Kelly says quarterly if your CPA nags you. I want to come back to why a CPA would be nagging a realtor to calculate their profit and loss at least quarterly instead of annually. One reason is so that if you're going to have to come up with $50,000 in the month of April, it would be better to know that in advance. There's other reasons to that we're going to come back to, but yeah, good point, Kelly. Do you guys have the Kelly, Jenny, and Trisha, do y'all share a CPA? Because it appears they're doing a good job of hassling you quarterly. That's because they've had a client maybe almost go under in April after having a really good year. That's probably why they're nagging you. So taxes is one example. What's another means that people in our industry use to think about profit and loss? What's your revenue? If you wanted to calculate your revenue as a realtor, what's the easy way to do that? It's your 1031 from us. You could check at any point in the year. It'd be very easy to determine, like, well, my brokerage has to account for this, and they send me a 1031. You actually get the 1031 at the end of the year, but you're getting 1031 independent contractor payments through the year. Geez, I've done several 1031 real estate exchanges in the last 2 weeks, and I haven't slept enough. Thank you, Jenny. You're like, what the hell's a 1031? I don't get a 1031 from Platt. No, you don't. You get a 1099 from us. Thank you, Jenny. So it's the balance of what your 1099 is for that point of year. That's your revenue. What do most realtors use to keep track of their expenses? I know some of you know the answer to this.
Credit card statements?
Yes. They maintain a business credit card. And when they're going to buy something that's associated to their business, they use their business credit card or a bank account. Yeah, thank you, Andrew. They might have a separate banking account that they're going to always spend out of that bank account. But you got to have something. So your revenue in our industry is easy to keep track of. Your expenses, a lot of times people are just going to use a specific credit card and they're just always going to get a statement of that. And at the end of the year, they're going to like hand two things to their CPA. Their 1099 and their credit card statement. I got no problem with that. It's a nice, clean, easy way to keep track of income and expenses. And that's going to help you determine what your profit or loss is for the year. Now let's try to apply the balance sheet. So for a realtor, January 1 to December 31st, your profit loss is your 1099 from us and your credit card statement showing what all you spent on your business. If a realtor is going to maintain a balance sheet, since we're pretty much sole proprietors, does a realtor own many things as a realtor that are of value? No, I'm seeing a couple of you shake your head no, right? So I'm going to make the case that I don't really care too much if a sole proprietor like yourself is maintaining a business balance sheet, because there's going to be hardly anything on it. What I do care about is that you're maintaining a personal financial statement. So here's our transition. A personal financial statement is a balance sheet. A balance sheet, typically that term is used to describe that snapshot for a business entity. So an LLC or an S Corp has a balance sheet. A human being has a personal financial statement. A personal financial statement is the same thing. Okay? Everybody with me on that? Okay. So my push to you as a realtor, I don't really care about the balance sheet. What I care about is that you have this concept of personal financial statement and that you have one. It's going to be vital for your future growth potential, for your planning, for your goal setting. So if you don't, that you got to have it. This is the assignment that I'm going to ask for by the end of the fourth session, is that I want each of you to somehow prove to me that you have a financial statement. So I'm going to share my screen and pull up an example of a financial statement, and it's going to look a lot like that balance sheet. So this is I use Microsoft Excel. I'm going to send this out that you could use as a template. Some people like to use cloud-based software to do this. I've always just used like a running Excel document that I'll come in and edit things usually once a quarter. You could do that either way, but I'll send this out. So this is very similar to a balance sheet, but it's designed for you as a human being. So there's information at the top. And a lot of times banks will have like their template that they'll want you to use. We'll talk about why this matters for banks later. So on the left side, you've got assets. Starting with cash, the easiest to determine, savings account, checking account. Other cash might be like actual green bills. For some reason, somebody might keep a couple $1,000s of those hidden somewhere. Notes receivable, this is money that's owed to you. May or may not apply. Capital stock or investments. This is relevant for realtors. A business that you own. So some of you might own an LLC that you have rental properties or flips in. Well, if you don't own that rental property in your personal name and you have set up an LLC that owns it, the address of the rental property should not show up on this personal financial statement. Why? Because you don't personally own that property. That LLC needs to maintain a balance sheet, and the LLC shows up here on this capital stock or investment. So let's say you own 100% of that LLC. You have no co-owners. Well, whatever the equity is for that LLC's balance sheet is going to show up right here. So that LLC on its financials might show that it's worth $100,000. Well, then right here, you own 100% of $100,000. So that's going to say $100,000 in that line. Okay. That's why that says 1,000. So that would mean 100,000. Might be some confusion there. That's okay. We'll come back to that. Life insurance. This is not the future payout of life insurance, but the declared cash value. You don't have life insurance, you should probably pretty seriously think about that. We could talk about that another day. I could introduce you to somebody that's really great at helping you think through it. Securities. This is kind of usually tax sheltered savings method. So an IRA, a 401k, a 529 for any of you that, if you live in Indiana and you have young kids and you don't have a 529 set up, I would really strongly challenge you to be thinking about setting up a 529. Really good tax strategies there. So you don't have to worry about what a 529 is right now, but the point I'm making here in the personal financial statement is it's a really clean way to help you strategize about net worth, because it shows it all right here in one setting. Personal property. This is not your house. This is a car or jewelry or an art collection, or if you think, hey, my clothing, I own $10,000 worth of shoes, whatever that is. I'm going to be, I would encourage you here to be cautious about putting value in personal property, because personal property is generally a depreciating asset. I typically don't show much value here other than like a car. If you own a car, you could probably pretty easily determine what that car is worth to some reasonable level. And you should put it here because you're probably going to have an opposite entry because you borrowed money to buy that car. So you should put this, I would just say on personal property, you want to try to be conservative on what it's worth so that nobody could come back and challenge you and say, wait a minute, the contents of your house aren't worth $20,000. The Kiyosaki and Rich Dad Poor Dad, he talks about this. You might recall that chapter where he was talking about not thinking about personal property as an asset because it probably isn't generating any income. So just be very conservative. Real estate, your personal residence, if you own it in your name, would show up here. Or if you did own rental real estate that had your name on the title, you would put it here. And some of you probably do. So that's the asset column. On the liability column, unsecured loans. This is stuff, is credit card debt, medical debt, student debt, money that you owe to people that isn't secured by an asset like a house or a car. Okay. Notes payable. This is money owed by you. This would be like if you had if you had taken a loan from a friend of yours. So like $20,000 loan from a friend of yours. Maybe some of you have done that. Or like if you had taken an investor on and they had actually lent the money to you as a sole proprietor human being. Insurance loans, not very likely that any of you have those, but this would be like a loan against a life insurance policy that you had. Secured loans would be, this would be like where a car loan would go. A real estate loan here is a secured loan, but most financial statements will differentiate, like this is non-real estate secured loans. This is real estate secured loans here. Taxes payable. This is where an accountant might want you to go ahead and drop in throughout the year. When you have made through 6 months of the year, you've made $100,000 and you haven't paid taxes on that, you're not making quarterly estimate payments, you're going to owe that money. So you might as well go ahead and account for it. So this is where you're essentially showing it like it's debt because you haven't paid it yet. Real estate loans, you could have a mortgage or a HELOC. And there's kind of the catch-all other liabilities here. some kind of random payable that you might have as a person. So if your total assets, your total liabilities, that calculates your net worth. Most then personal financial statements will have other income that a lender or a CPA is going to ask you for. So the income that you make in a certain year here in this section, again, this comes to the difference between profit loss and balance sheet. So this does not calculate in your net worth. This just might be something that a banker would want to see as a part of that information. Oftentimes they'll ask for references, some other personal info. I don't know what Rosie's 21st century comment was referencing. That was probably from a while ago.
Because you still use Excel. Duh.
You know what? Bill Gates is still doing just fine. I want to give you some examples as to why a personal financial statement matters, to try to give you a little bit of extra motivation to go and do this, and then talk a little bit about like the fears we have surrounding them. But I know we only have 10 minutes left. Is there something in that transition from balance sheet to personal financial statement? What questions do you have? It looks like several of you are typing, which means I'm going to get like 4 questions in a row. Oh yeah. Jenny, if you have a HELOC in place, but the balance is 0, you wouldn't show it on your personal financial statement. You would actually probably have a line item that says HELOC, and then you just have it say 0. Because when you borrow money on that HELOC, you just go and borrow $50,000. Well, then you have to add the liability of $50,000 because then your checking account just went up in its balance by $50,000. And then you're going to go spend that money on something. Yeah, if you own a percentage less than 100 of the company, do you just account for that? Yes. Interestingly enough, and someday if any of you like want to see my personal financial statement, I'd probably show it to you. I don't get like worked up about that stuff. I'm not going to bust it out in a group Zoom call. But little interesting side note for me, there is no company that I own 100% of. Any small business that I own, any general ledger that I own, I have some partner in. And so mine is going to be a percentage calculation of that company's equity. So I might own 3%, I might own 75%, I might own 51%, but I am calculating that percentage when I put it onto my personal financial statement. Angelica, yes, right? Most personal financial statements are very simple. Not a problem with that. You have to start somewhere. And by the way, many of you on the call, when you fill out this financial statement, is the number under equity going to have a plus sign or a minus sign? For a lot of you, it's going to have a minus sign. That's not a problem. I mean, in the long term, it's a problem, but it's one of the main reasons that people don't fill out financial statements. They think to themselves, my net worth is negative. I owe $100,000 in student debt. And because it's student debt, it's credit card debt and medical debt has an impact on a lot of financial statements. But right now in our country, most people in their 20s have negative net worth because of student debt. You have to make the spreadsheet. You have to start establishing goals and understanding how you should make decisions about, should someone with negative net worth really go and buy a life insurance policy? Well, if you don't have a personal financial statement, you don't even have the right information to answer that question. Phil and Jenny, are you guys making business deals here on our chat? I think you guys need to take that elsewhere. Jenny, I'll give you 10 and a half. Yeah, Tatum says, if you're married, do you have to put it all on of your spouse's stuff too? It varies. It really should depend on how you file your taxes. If you are married and you file jointly, then you kind of have to maintain one financial statement. If you file separately, you then should probably maintain different financial statements. For the record, you are the loan shark in that. Yeah, okay. I was like, not me and Phil. Okay, I'm going to give you a couple examples. Maybe you need some motivation or inspiration, maybe you don't, but I'm going to give you a couple examples for a realtor. Why having a personal financial statement would matter, why it would come into play. Number one, you can't orient your goals to net worth rather than income if you don't have something in front of you. You have to know where you are right now and where you're trying to get. And if you don't have that, you have no orientation for goals to be around net worth instead of income. Okay, so that's number one. Number two, realtors can make a lot of money, and a lot of realtors make more money than they need to live on. And then they're going to start making decisions like, how do I invest that money? And what's my tax strategy? How do my investments and my tax strategies, how do they relate to each other? Well, this is a starting point to help you make investment and tax decisions, is using a personal financial statement. Number three, your ability to borrow. We talked about the if all you look at is 30-day periods of time, debt is generally looked at as a bad thing. But yet, for some reason, the wealthiest people in the world always utilize debt to their advantage. So looking at like your starting point being a personal financial statement helps you correctly understand the difference between unsecured debt, like credit card debt, and secured debt, like real estate debt. And then you really get into the nuance and you can start to tell the difference between secured debt that produces cash flow versus secured debt that doesn't produce cash flow. You borrow money on your car, it's secured debt, but it's not producing cash flow. Borrow money on a rental house, that's secured debt that produces cash flow. Big difference. But having a personal financial statement will help you understand debt correctly and when you need to go and get it. How many of you have had the experience of trying to get a mortgage and it was harder than you thought it should be because you're self-employed? I know a lot of you have. I've talked to a lot of you about this. A personal financial statement isn't the silver bullet to that. But if you have a like well-articulated, thought-through personal financial statement at your disposal, it's going to help you access debt for being somebody who gets 1099 income that can vary a lot year to year. Yeah, Kelly, you're right. You guys, I mean, I was giving Rosie this example, I think yesterday. I literally had a conversation with my banker this fall, one of my bankers, kind of my go-to person that I borrow from more than anybody else. I ran into a little bit of a challenge borrowing money from them this year, more than I had in years past. And I said, hey, I need you to tell me what you want my tax return to say. And guys, this is legal and this is how this works. And I said, I want you to tell me, you have my personal financial statement. So in light of that personal financial statement, knowing what I'm probably going to want to borrow next year, tell me what you need my tax return to say. And I'm not talking about then I'm going to go out and fake something. If you have a really coherent tax strategy, you may actually have to, at some point in time, show more income on your tax return than you would have otherwise in order to be able to borrow money. But that's the life of being self-employed, is that you have the flexibility to do that with income that most people don't realize they have. But you better have a personal financial statement before you start doing that. Also, by the way, we talked 2 days ago, I mentioned that I think realtors are perhaps in practice less generous than they would like to be in theory because of the unpredictability of our income. This is a really good reason that realtors should have personal financial statements. If you're focused on your 1099 minus your credit card statement, you're going to be anxious about the volatility of those two numbers. If you have a personal financial statement, you can start to be more strategic about giving. And I think actually probably more, I don't think the personal financial statement makes you more generous, like in terms of your attitude, but I think it can actually help you align your real giving to your intended generosity, especially later in your career. I'm always happy to share more about that. I just wanted to rattle off those 5 examples as to why a personal financial statement becomes relevant. So later today, you're going to get that template. I'm fairly certain that Rosie's going to somehow convert this to a Google spreadsheet rather than Excel before she sends it out. That's fine, whatever. You don't have to use that one, but I think it's the 4th time I've reminded you, I am going to ask for proof that you have a personal financial statement. I don't care if you take a screenshot and take a Sharpie and put out all the dollar amounts, that's fine. But I'm going to make you prove it to me. We'll end with Joel's question. Can you speak to S-Corps and how this could help with both tax liability of realtors as well as their stability piece? So in S-Corp or an LLC, there's multiple advantages. Some of them are tax strategies, like you gain flexibility in taxes by setting up corporations. You could also, if you're buying investment properties, you can gain like a liability shield. You get some protection when things aren't in your name, if something were to go really bad. So there's both tax advantages and liability, like insurance advantages to setting up corporations. We're going to hit on that maybe a little bit in 102 under tax strategy, but I'm going to just probably punt the LLC versus S-Corp to say, maybe I'm going to convince you as to why that question matters a lot, and then suggest get a personal financial statement and start working with a good CPA who can help you think through those. Rosie, take it away. Thanks, you guys.
Thanks, Mark. That was great. I have 2 reminders for you. One, remember that our pie tea is tonight from 4 to 7. It's a drop-in event, so feel free to come. Bring your families. We'd love to see everyone. Everyone will be masked up. We'll have bonfires, and it's going to look like a winter wonderland. Gigi has outdone herself. How amazing this is going to be. So hope you guys can show up. Also, our new t-shirts are bomb. I can't wait for you to see them. They're much more indie-centric than they are plat-centric, and that was purposeful. We can talk more about that some other time. And then lastly, this is not for the people on the call, but for those who are watching the recording. If you didn't make it to yesterday's and didn't hear this message, make sure you send me your name so I can get you guys the resources you need later. So that's all. Hopefully I will see all of you tonight. Adios.